Hello everyone, welcome to week 2 lecture videos once again, and this is the last video this week. In this video I'll be talking about insolvency risk and other risks and interaction among the risk. Insolvency risk is the risk that a financial institution may not have enough capital to offset a sudden decline in the value of its assets relative to its liabilities. You can remember we learned about interest rate risk where we said that as the interest rate increases, the value of asset and liabilities both declined. Now under certain circumstances, asset values may decline more than the liability values. As a result, the total asset may be found insufficient to cover the liabilities. So that's creates insolvency risk for a bank. Insolvency risk is a consequence or outcome of one or more of the risks described earlier, like interest rate risk, market, credit, off-balance sheet, technological, foreign exchange, country, and liquidity risk. Technically, insolvency occurs, as I already have said, that when capital or equity resources of a financial institutions are driven or near to zero due to losses incurred in the results of one or more risks that we have described in this way. In general, the more equity capital compared to borrowed funds that an financial institution has, the lower its leverage, the better able it is to withstand losses, whether due to adverse interest rate changes, unexpected credit losses, or other reasons. Thus, both management and regulators of financial institutions focus on the financial institutions' capital adequacy as a key measure of its ability to remain solvent and grow in the face of a multitude of risk exposure. So overall, insolvency risk is the potential that banks' assets may be insufficient to cover its liabilities due to any of the risk we discussed so far. Um, Other risks. So far we discussed about 9 major risks that financial institutions are exposed to. So these risks are as interest rate risk, market risk, credit risk, and so on. Although we describe these risks independently so far, in reality, these risks are often interdependent. For example, when interest rates rise, corporations and consumers find maintaining promise payments on their debt more difficult. Thus, over a range of interest rate movements, credit and interest rate risk are positively correlated. Furthermore, the financial institutions may have been counting on the funds from promise payments on its loans for liquidity management purposes. Thus, liquidity risk is also correlated with the interest rate risk and credit risk. The inability of a customer to make promised payments also affects the financial institution's income and profit and consequently its equity or capital position. Thus, each risk and its interaction with other risks ultimately affect solvency risk. Various other risks, often of a more discrete or event type, also impact an financial institution's profitability and risk exposure. Discrete risk might also include, for example, events that external to financial institutions, such as sudden change in regulatory policy. This include the liquidity support measures introduced by the Australian Prudential Regulatory Authority as part of Basel III regulatory reforms, which represent significant changes to liquidity regulation for Australian banks and other depository institutions. Other discrete or event risk involves sudden and unexpected changes in the financial market conditions due to war, revolution, or sudden market collapse, such as 1929, 1987, or 2008 stock market crashes. Other event risks include fraud, theft, earthquakes, storms, illegal acts, corruption. All of this can ultimately cause and financial institutions fail or severely harm. Yet, each of these risks is difficult to measure and predict. Finally, more general macroeconomic risks such as increased inflation, inflation volatility, and unemployment can directly and indirectly impact and financial institutions' level of interest rates, liquidity risk exposure. For example, Inflation was very volatile in 1975 to 1989 period in Australia, and financial institutions' interest rate risk exposure from mismatching its balance sheet maturities tends to rise. Its credit risk exposure also rises because borrowing firms with fixed price product contracts are often find it difficult to keep up their loan payments when inflation and interest rate risk abruptly rises. In the United States, unemployment rate rose above 10% in April 2019. This was the highest unemployment level since 1992, and the loss of jobs dramatically increased financial institutions' credit risk exposure, and borrowers had trouble making loan repayment. So this is the end of our discussion on this chapter today. Thank you very much for listening. And if there is any question, don't hesitate to send me an email and ask me about that. Thank you very much.